No tax returns, no personal income, no W-2s, no 1099s, no pay stubs. None of that's needed, right? Because what we do is we focus solely on the property's ability to make the mortgage payment. Now, don't get me wrong. We're going to look at you and your credit history and your payment history, right? But we're not using your income any bit whatsoever. We're using the property's income, to qualify for the loan.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer. With me, excited to have Jonathan, you, and Dustin Rosenberg. How are you guys doing today?
Good. How are you?
Doing excellent. So, Jonathan and Dustin are the co-founders of Convoy Home Loans, which is one of the top DSCR lenders in the U.S. with over $1 billion funded real estate investment loans under 4 years. So I want to dive in a little bit with you guys. Why don't one of you pick and just a little bit more about your background and kind of what Convoy is doing, and then we'll get a little deeper.
Yeah, so the company started, I guess, more so like 4.5 years ago now. And Dustin and I, we both worked more at a traditional shop previously, and we saw a lot of holes in the sense of underserved communities, we like to call it, right? And at the time, before DSCR was a big thing, before all these other non-conventional type loans were a big thing, everyone was trying to go for the VA, FHA, conventional, low rate, primary owner, and then if you were an investor that didn't have a good track record on paper, right, on taxes, then you would get screwed, right?
Yeah.
And so we really saw that hole and saw an opportunity to pivot and say, hey, if we start our own company, we want to make sure that we are catering to the underserved communities, meaning investors and luxury real estate, the two places where conventional FHA and VA don't really play. So that's where we kind of started the company. And then we were actually one of the first brokers to bring DSCR to market and do it a little more mass market across the country. And then we kind of kept developing that aspect and trying to get more and more investors to be able to, put in money into real estate and grow their wealth, right? Because we're investors ourselves. So we wanted to kind of preach what we practice. And back then DSCR rates, we were doing loans at 40-year fixed at like 3.125, right? Those are the good days. While everyone was chasing conventional, we said we have to go towards the investor type market. So we pivoted our entire company and created it around that basis, and that's how we kind of got to where we are to get today. And with the niche in investment real estate and luxury real estate, I think it allows us to really focus on that aspect for a lot of clients, besides just being a primary, here's one transaction. It's more like a relational, help us help you walk through the investing journey where you get from one door to 1,000 doors.
Wow. I remember when I first started, I was buying single family homes, and this was 2008 to maybe 2009. I think it was 2008 and 2009. I'm buying single family homes, bought a duplex, and I bought a primary home for myself. And I ran out of the ability to purchase more properties because I had 4 loans in my own personal name. And that at that point in time, that was basically all you could have in your personal name. And then it went up to maybe 10, I think, traditional loans. But at that point in time, I had to figure out how could I continue to buy properties, because there was really no other very good options. Ended up doing some deals with local banks, but what you're doing with these DSCR loans has really changed kind of the industry and or given a lot more opportunity. What is DSCR? Like, explain to the listeners what it actually is.
So what it stands for, the acronym is debt service coverage ratio. And in simplest form, it basically is asking, is the rent that the client or the owner or landlord receiving higher than the mortgage payment? So, for example, if the rent that they can collect from the tenant is, $1,200 a month, and the mortgage payment is $1,000 a month, 1,200 divided by 1,000 is 1.2. That's the ratio we're looking at. And we always want to, you're going to get the best terms when that ratio is above 1, meaning you're cash flow positive, right? And that's the whole premise of the DSCR loan is, like you said earlier, we're focused more so on the property's ability to generate income and be able to self-sustain the mortgage payment rather than diving into your own individual finances and, personal business tax returns.
So you're going to get better financing if the higher the DSCR. So let's just say I come to you with a property and looking for a loan, and the DSCR is 1.9. Am I going to get better terms than if I come to you with that same exact property, but the DSCR is 1.2?
Typically over like 1.4, there's not really a difference in pricing. It depends on where we send it, right? So because we do so much volume now, we have so many outlets that, a lot of brokers will kind of come into the market and say, we can do this program, but unfortunately they only have one lane. For us, we have, 100 different lanes just because we've been doing it for so long and with so much volume. Obviously, a lot of these loans are traded on the secondary market, which is Wall Street for them, not Fannie Freddie. So Wall Street hedge funds, insurance companies are kind of the end buyers of all these types of loans and big banks. And we have direct access to them. And so it allows us to kind of maneuver whether it's going to be a 1.4, it'll probably fit better in this bucket because it gives this much better pricing. If it's a 1.2, we'll put it in this bucket. If it's a 1, we'll put it in this bucket. And if it's going to negatively cash flow for a short period of time, we'll put it in this bucket, right? So we have a lot of different avenues to pivot from. It's definitely not a one size fits all, but we have a lot of different avenues. And with the DSCR loan, a lot of like commercial real estate investors are used to it already, right? And the debt coverage ratio, I want to kind of add on to what Dustin is saying.
Right.
And typically for commercial underwriting, they'll take like an expense ratio, be it utilities and a vacancy reserve and management. So the difference between the commercial DSCR and the residential DSCR being 1 to 4 units is the fact that on residential DSCR, it's only based on gross income, and then also gross income meaning gross rents, and then the PITIA, and the A is for association, principal, interest, tax, insurance, and association. Those are the only two things compared on a residential, sorry. And then on a commercial, obviously they take out that expense ratio, which typically requires people to put more down, and that's kind of more of the underwriting that commercial underwriters people are used to. But residential, that's kind of the biggest difference. And like you said, in your case where it's 1.4, it might actually end up being like 1.9 or 1.10, 2.0, and it doesn't necessarily give you a better term, but you're getting a better deal because you are underwriting it more conservatively, potentially on a commercial underwriting versus a residential underwriting.
Yeah, that's interesting. Why, or who's coming to you? Like, what type of? You already mentioned the investor, right? But why not go with the traditional Fannie Freddie versus the DSCR? And then I guess on top of that question is what type of terms does the DSCR loan get compared to more of a traditional? Because everybody kind of knows, okay, if I'm going to buy a home, this is what I'm going to get. How does that compare to DSCR? Obviously, there's different levels.
Yeah, I mean, we can do conventional, just like everybody that's in the mortgage industry. That's where you start.
Yeah.
Everybody gets their milk from the same cow, right? It's Fannie and Freddie or a government enterprise like FHA and VA. Everybody's going to get the same rates. There's no trick to the trade, right?
So you'll fill that bucket first if it makes sense and that works for the client. You'll go, hey, this is what's best for you. We'll put you in that.
Yeah, and the biggest thing is most of our clients are going to be experienced investors that have more than 5, 10, 20, 100 doors, right? You just can't go conventional. Right. That's the thing. So the only way to scale your business, your portfolio, is doing a DSCR loan, right? So the nice part is that since this came out, like you were mentioning earlier, you don't have to stop at 10 because Fannie's going to limit you at 10 finance properties. Mm-hmm. We have some clients that we've done over 100 loans for, right? There is no cap on the amount of DSCR loans you can get. And what's nice about it, is that the rates, they're always changing, okay? They're always changing. And when I say that, not just in general, but DSCR at some points over the last 4.5 years have been both lower, higher, or identical to conventional. Fortunately for us right now, DSCR is on average about a 1/4 point lower than conventional. So even if you're comparing the two, it's kind of a no-brainer, even if you qualify for conventional in this situation, not just for lack of or for the ease of underwriting, but for the actual financial terms you can get to go DSCR over conventional.
30-year AM still?
30-year AM, I mean, that's the most popular. No, I'd say 30-year fix with the first 10 years interest only is probably what we're writing the most of.
Yeah.
Wow.
And then there's also, if someone wants, and it made a lot of sense, like I said a little earlier, 4.5 years ago when rates were really low and we were writing 40-year fixed debt, fully amortizing or interest only at 3.125. But that's available too if anyone really wants to do like a set it and forget it and never touch it again type scenario. And then in terms of rates wise, if it's like 2 buckets that we have. If it's in your personal name and there's like you fit into the box, we have 30-year fixed debt down to 5.375. And then if you don't fit into that box, then we have things down to 5.75 in LLCs and different, avenues. And when I say down to, obviously you're buying down from whatever the starting rate is, but you have an avenue to do that. And what we've been seeing a lot of clients do is with the 5 handle rate, meaning like whether it's a 5.75 or 5.5 or 5.875, you're not going to be as tempted to refinance in the future when rates drop overall in the market. So it'll kind of future proof your asset, where it might not be worth it to refinance, even if rates drop to 5.5 without buying it down, right? Across the board. And that'll ensure that your cash flow and everything is at the best shape possible. But the benefit is you already pulled forward that benefit of having a 5 handle 2-3 years earlier than the rest of the market did, which is why people would buy it down. And that's kind of the cost benefit analysis that we would run for a lot of clients. The other added benefit to having a DSCR loan or a non-conventional loan versus just going Fannie Freddie or to a bank is being able to underwrite it into an LLC, right? Or an S Corp or some sort of entity where, one, it doesn't show up on your personal credit. So that helps on your, obviously, I don't know if any of the listeners, if you get a first loan, it pops up on your credit, whether it's $200,000, $300,000, that'll ding your credit negatively because you all of a sudden got a massive loan with no payment history, right? So, and then that limits your ability to purchase something else on the next run. So instead of that, if you have it in an LLC, it won't pop up in your personal credit, meaning your personal debt to income ratio on your credit report won't be affected as much, right? And it'll allow you to kind of keep it separate. And the benefit is later on, right? I'm sure a lot of your listeners love 1031 exchanges, one of the most powerful tools in real estate investing. It'll allow you to keep the LLC vesting from the 1031 exchange because most times you have to keep the same vesting on title when it's moved from one entity to another when you're purchasing and selling, right? Up leg and down leg. So what it allows for a lot of people to do is not have to panic to try to move something from their personal name into an LLC or vice versa. It'll allow them to maintain ownership within that and carry forward that, whatever they did on accelerated depreciation or all of that on the 1031 deferred capital gains to the next property on the up leg.
Sure. Yeah, makes sense. Well, a lot of investors, myself included, like we don't have W-2s. We depreciate the crap out of everything. So our income does not look good on paper. We're trying to expense as much as we can. We may not show much profit in our taxes. Can you still qualify for this type of loan without a W-2, without showing a ton of income on your taxes, that type of stuff?
Yeah, absolutely. And that's the, beauty to it. And we probably should have touched on that when we were explaining what a DSCR loan is. But ultimately, no tax returns, no personal income, no W-2s, no 1099s, no pay stubs. None of that's needed, right? Because what we do is we focus solely on the property's ability to make the mortgage payment. Now, don't get me wrong, we're going to look at you and your credit history and your payment history, right? But we're not using your income any bit whatsoever. We're using the property's income, to qualify for the loan. And that's why they're so popular, because you know this, but most self-employed, most real estate investors don't show anything on their tax returns. It's not, secret.
Yeah,
It's
that's the goal.
calculated because you're doing mass depreciation, you're doing write-offs because you want to show as little as possible so you don't pay as much to the IRS. But
Yeah.
the catch-22 is, if you go to a conventional loan or a conventional underwrite, well, they're going to look at your tax return and say, well, you don't make anything, so you don't qualify. But that's the issue we can, get rid of by going DSCR, because we don't care what's on your tax returns, right? And that's why it's such a powerful tool for, real estate investors across the country.
Yeah, I mean that is super powerful right there, because that always is the biggest challenge. I mean, shoot, I living in the house I'm in right now, I was, this is personal house, so it's different, but I was trying to get refinanced with when rates were super low. I actually wanted to reduce my mortgage. I wanted to get a 15-year versus I was on a 30-year. And I couldn't get qualified because even though that year I had made multiple six figures on my tax return because of depreciation and things like that, I showed a loss. And so I couldn't even, they wouldn't even talk to me about a refinance, even though it was going to be a much safer deal for the lender.
It's funny how it works that way.
Yeah. And I mean, we joke about it all the time, but W-2 on paper, for some reason, seems like the safest job, right? Security. But in reality, it's probably the least safe, because you are just, no matter, and this is no offense to any W-2 people, because, you have a stable job, you have a career, but at any moment, the boss, whoever the head honcho is, could say, hey, your jobs no longer exist, which right now we're seeing a lot of with the movement of AI, right? We're seeing a lot of our peers lose their jobs that have been in 10, 20 years in big names like Microsoft and Google and all these places. Like, that could happen at any day, right? So in reality, how do we fill the gap between being able to qualify because of a W-2 and then also being able to qualify as, let's say, a landlord, self-employed person, someone that creates jobs, right? That type of bucket. That middle gap is where we fill using DSCR, using the bank statement programs that we have, profit and loss programs. Like, that's where that came in. I think back in that time when you were trying to probably do a refinance, unfortunately, someone probably underwrote it the wrong way, because you can always add back depreciation. So it should have brought your income back to a pretty big positive. But the underwriting guidelines now for real estate investors, I feel like, have loosened up a bit across the board. And I think that allows for the investor and the self-employed person to have a lot more options than they used to. And I think, again, in terms of building wealth, that is the pathway to go.
Yeah, I mean, the options are, having this option and other options that are now available is, I think, is really amazing for real estate investors. I wish it was around when I was building my 1 to 4 family rental portfolio. And in fact, now that I'm thinking about it, I've got a portfolio of loans that are coming due in just a few years, and this type of loan product may be a good refinance strategy for me to get into. Of course, I'm just selling some of those buildings here and there as they kind of piss me off, but I'll still have some left probably. That this could be a good product. I mean, 30-year, shoot, if there's interest only periods, I mean, that's amazing. And it sounds like the rates that you guys, obviously you said they vary, but the rates that you guys have already mentioned are solid rates for what's going on in the market. So, what are there any other creative, somebody's wanting to build their rental portfolio, they want to try to get in and get as many properties they possibly can. Is there any other creative ways you guys can help that person along and to be able to grow their portfolio?
I mean, the DSCR, like we've touched on, is the most popular for real estate investors. But if that doesn't work, let's just say you are buying a property that ultimately, like, day one isn't cash flowing well.
Yeah.
Right. But, you know that you're going to put a sizable, remodel in or addition or add a bedroom, EDU, etc. A lot of the times you can do what we see our clients do is number one, they'll do like a bank statement or a P&L loan like John just brought up, which is ultimately not using tax returns. So we don't have to worry about the, write-offs or depreciation or deductions that somebody that's self-employed might have or probably does have on their tax returns, and rather look at their deposits that are coming into their bank account and generate what their income is looking at their bank statements, not their tax returns. Same thing for a P&L. We'll get sometimes a requirement where it needs to be audited depending on how long you've been in business. Sometimes we won't need it audited. You can just literally self-prepare your own P&L, and we'll kind of vet it a bit with bank statements. But the other that is very common in real estate investing that a lot of real estate investors are in is the fix and flip, bridge loans, where you're ultimately buying a property that everybody knows is needing rehab, and your plan is exactly that: buy it, get the rehab portion financed through the bank or us or the lender, etc. That way, no additional money is spent out of your pocket to actually fix the property up.
Yeah.
Once you're done fixing it up, whether your plan is to hold it and build your portfolio, that's great. Or if you're going to sell it, make a pretty penny and rinse and repeat. Right? Those are probably the two most, I'd say, popular behind DSCR loans that we're doing right now for our real estate investor clients.
Is there a way to, I know like when I was doing a lot of these, it was really challenging when I would buy, I'd buy in foreclosure. So I'd buy a property for, let's call it $40,000, stick another 30,000 into it. Then I'd get a tenant in there, we'd rent it for $2,000 a month, and we could only get a loan for, 80% of our purchase plus our renovation costs, even though we had a ton of equity. That property was now maybe worth $200,000. We're all in for, I don't know, call it $80,000 or $100,000. Is there a way or does the DSCR loan allow you to get in and do something like that and actually capitalize properly on it, where you can?
It's amazing you brought that up as a point, because that's what we deal with a lot with our investors. And we have programs with 0 months seasoning, meaning the period between when you purchase the property on title and then when you go to do a loan, right? That seasoning period, depending on what the strategy is of the individual, we have different buckets for those too, right? So we have pricing and products for clients that are within 3 months, and they want to use the ARV, which you were mentioning is $200,000. The after repair value, I think, is the important aspect there. We can use that within the 3-month period. We can use it from 3 to 6 months. It maybe gets a little bit better in pricing from terms perspective. And then from 6 months plus is the best pricing, right?
Sure.
So you will get a little bit of a hit, but the churning aspect, especially when you're following the BRRRR method, like it's important for you to be able to take out the capital that you put in plus a little bit so that you can rinse and repeat if you're holding it. So a lot of clients will take that 0 to 3 month period, even if it's maybe 0.5% or something, a little higher than the 6 month plus period, because it's worth it for them, because they know that if I take this money out at, like, call it 6,875, then and go utilize it and buy something else and rinse and repeat, I'll make more than 7% on that return.
Yeah.
So it's a no-brainer. I netted positive 1/8% extra on the money that I just took out, and I'm just going to do it again and again and again, and then it allows you to build a portfolio a lot faster. And to your point, investors should be doing the work in terms of buying properties like that are distressed and won't pass a normal conventional loan, because that's what people are afraid to get into. But if you get into that and you're able to successfully turn it, then every dollar you have in there is straight multiplied by 2, 3x, 10x, right?
Yeah.
Which is your example.
Yeah, that's where the honey is getting into those types of deals. And so
Yeah.
that would always drive me nuts, where I'm going, wait a second here. I would even like, hey, the DSCR is going to be like a 2.0. I'm not asking for the world. I'm all in at 100. I want a loan for 100. right? I just want my money back out so I can go buy. I got 7 more properties I want to go buy, and I can't buy
Yeah.
any of these. You're punishing me for being really good. So that always drove me pretty crazy when I was doing it, getting punished for being good at what I did. Uh,
Yeah.
so
And that's the problem that's the gap we've been filling a lot for investors. And Dustin and myself, we're investors ourselves. So we see pockets where things can be filled. And what we do is, we take our volume, we take our flex, as you may, go to the market and say, we have this gap, we have, $100 million that we can fill of loans within this bucket. Can we provide a solution for that bucket? And a lot of times what the investors will end up saying is, yes, we can. Here are the guidelines for it. Here, go out and deliver, and we'll basically fill that bucket and keep going and building from that baseline. So
that's
we
great.
we see that a lot. Another thing that Dustin was didn't mention about DSCR aspect too as another type of program that I wanted to bring up is right now, obviously, for a lot of clients, it's kind of a buyer's market, right? We're still a little bit in that buyer's market phase, depending on the market you're in. Some markets are very hot, some markets are very slow. But if you find a distressed seller or someone trying to get, you've seen the property listed for a while, you look on title, you realize that they might not have that much of a loan on it. Seller carried financing has been extremely popular for us. So whether that's a 90-10-10, meaning 90% for first and second, and you put in, 80-10-10. If it's 40% on the first loan that we fill, 40% seller carried second, and then 20% down, or whatever that kind of bucket is filled, up to 90% combined loan to value, where the client only has to bring in 10%. That's a very popular program that's going around right now in this market, just because a lot of buyers have leverage, I think more than they did previously. So if they have a client that has a bunch of equity in there, they can say, hey, I want to buy this property. I only really have 10% to put down. Can
Yeah.
you carry 30% of the equity, the purchase price, as a note, and I will have a lender come in and fill the 60%. And we've been doing a lot of those transactions. That'll open up a lot of investing opportunities for new buyers that are trying to enter the market. And the power of that is, let's say the valuation of that property that you're buying with 10% down, 15% down, whatever that lower down payment is, with the seller carried financing. The rate on the first loan is higher. It's like 9, maybe high 8, low 9 type scenario. But then if you get a good second, in the sense of like maybe it's a 5% or a 4% or a 6%. If you blend those together, you end up getting a blended loan of like rate of like 7% or 7.5%, which is around where the normal market is. And
Yeah.
if you have that later on, if you stabilize the property and you build equity, you can always refinance out of that loan and put yourself into a 5 or a 6% next year or in 6 months, whenever that time frame is, and that'll allow you to kind of build, I think, equity very quickly and allow you to purchase a lot of properties that you thought you couldn't purchase in the past. So that's another powerful tool within the DSCR realm that allows a lot of buyers to really enter the market and a lot of investors to take advantage of the market sense of where it is right now.
I mean, something that's really not available to with any other traditional way, or even local banks. I mean, some of them maybe can get a little bit more creative in that, but I've tried that with a lot of local banks, and they still want at least that 20% down payment, sometimes more, and so it's challenging to even do with kind of your local bank. So it's a great tool. I want to pivot over to just kind of building your business and what you guys have done successfully, so our listeners can hear a little bit about that. So talk to me about kind of, I don't know, maybe some success, habits or tools that you guys have found to be really beneficial to building and growing your business over the last 4.5 years.
Yeah, I think, the number one that me and John definitely are proud of, and it can be exhausting from the day to day, but putting in the work, not just, working 8 to 5, but we work around the clock, and we enjoy it. You got to enjoy it.
Yeah.
And yes, we started with the two of us, and then it was really, We started with the four of us, day one. Now we've got about 50 on staff that are all part of Convoy Home Loans.
That's great.
But building and hiring people that you trust that also are part of the culture that you're trying to build, we felt was very, very important. We don't just hire people that are, looking to be a loan officer. We don't just hire people that are looking to grind or work hard, but people that actually fit our culture that we've built. And basically right now where we've, knock on wood, been able to be so successful is we're trying to take as much of the real estate investor market as possible, which we're in all 50 states. So if you think about it, being licensed in all 50 states or being able to originate and close loans in all 50 states when our company's 50 deep, right? It's pretty, if you have the background and the pillars set, easy to stay busy because we're marketing, we're doing podcasts, we're going to a lot of meetups, we're going to anything that we can get our name out there, and it's growing, knock on wood, at an exponential rate that truthfully me and John didn't think it would be 4.5 years ago.
Yeah, that's exciting. That's fun. Jonathan, what has been one of maybe a realization that you didn't think starting in the business was important, but now you realize that it's critical to your success?
I think the biggest thing for us is the importance of a relationship. And what I mean by that is a lot of a lot of relationships in real estate or in a sales position or like service as a sale type position, like you are going to have a transactional moment to it, right? At the end of the day, money is exchanged, transaction happens, and a lot of people stop at that transaction, right? And
Yeah.
that's the extent of their relationship, and that's what they call the relationship with the client. For us, I think the most pivotal thing has been that we didn't realize before was how important it is to maintain the relationship beyond just the transaction itself and to really be embedded into a client's financial well-being, right? And what I mean by that is sometimes it also means telling a client whether no matter how much they want the house and no matter how much they think it's a good deal, that if you know it's not a good deal, to tell them it's not a good deal and to say, hey, sorry, like I can't in good conscience do the loan for you because I don't think it's a good fit for you and it's a good loan for you. You may not see it right now and you might hate my guts for it, but later on you'll understand and you'll come back and you'll be like you'll know where I'm coming from. So it's kind of like how a parent sees a child, right? Not calling anyone children, but we want to kind of create that relationship where we're really able to guide a client through and be able to tell them no, right? And they trust our no. And the only way that they trust our no, that's not a good deal, is if we have that relationship where they know that we are on their side for the financial well-being of their portfolio and of their life, right? So, and a big part of a lot of investors in general, if they're not in the stock market, is real estate, right? So a lot of people are in one or the other. And so us being focused on the real estate aspect and us knowing the power of real estate and also getting the knowledge and experience from, we have clients that are worth, a lot of B's, like billions, right? And with those clients, getting the knowledge and experience from what they're doing and being able to be like, okay, how can I take that knowledge and experience and exposure that we received and help a client that is starting out kind of look at a bigger picture beyond just this one transaction has been something that we didn't realize would be so powerful, but now it's kind of yielded to our constant, success and growth year over year.
Yeah. Yeah. So, I mean, I appreciate you really bringing that real life kind of scenario and how you guys deal with it, because it's really easy to have a relationship that's just that surface level where it's a transaction. That's what you call a relationship. In fact, like you mentioned, like that's the majority of how companies do and what people do is they build a relationship based on the transaction and they don't go beyond that. And that's a real big challenge to make sure you're focusing on how do we create a bigger relationship than just the single transaction or the transactions that take place. What's a mistake that you guys have made? And maybe both of you want to tackle this, but what's a mistake that you've made and how have you learned from it?
That's a great question. The biggest mistake that just pops up a lot in my head was not starting sooner rather than later, because it was, we had it good at our previous company. It was, what we thought at the time. Mortgage rates were so low. It was,
Yeah.
to a degree, shooting fish in a barrel, right? Because everybody, could benefit from a 2% mortgage rate on their primary, right? And everybody was doing it. But I wouldn't say learning from that mistake is the best way to put it, but anybody listening, and not to sound cliche, like if you have a hope and a dream and you want to be a business owner, which I truly believe is the best spot to be in, the work environment or workforce, of being the business owner. Take the risk. If you need to take a little bit of a gamble out financially, or you need to build the bank account a little bit more for reserves before you do it, but you can't be, and this is not again a knock on any sort of W-2 employee that's watching it, or any of our employees, right? But you can't grow the wealth as much as most people would like to, being stuck as a W-2 employee as opposed to a business owner. So I wish we did it sooner.
Yeah, for sure.
Absolutely.
I think for myself, Dustin kind of stole mine, but to piggyback, I think on it, I think the way that we built our culture, because we talked about our culture a lot in terms of how we build our company and where our success is. We really built it so that all of our employees have the power and the feeling of being that business owner, right? That a lot of mortgage companies will just have come in, take calls, just go through the list, and then just dial through everything and then finish your day. What we really want to do is create a sense of ownership for a lot of our employees, and we pay them accordingly to that. We make sure the transparency is there. And I think when we first started the company, Dustin and I, we were so busy with trying to get the company up and running that we, at that moment in time, didn't do as well in terms of creating that type of culture that we wanted to, to where we are right now, where we can confidently say that our employees are happy because we've created the culture of, you are, obviously there's an overarching business, but you are a business within a business, right? And the relationships that you build within your business should align with our core values of how we handle relationships as a whole, right? And that's kind of, I think, something we've tried to implement further along the way of, in our business building path. But right now, I felt like that's something that we could have implemented at the beginning a little better, when we've had, employees that we've lost, just because we didn't have that vision built out for them.
Sure.
And now, we have that built out. So a lot of our employees are staying. And obviously it's the same as a normal business. If you can't perform, unfortunately, you can't be a business, right? You have to perform in order to be a business.
Yeah.
And, that's the only losses we ever have if people don't perform. But for the most part, everyone's on board with the vision of, I have my task of building as many relationships as possible within my circle. And then, they know that the company, us, we are here to back them in that front, and then try to help them build the best relationships possible so that they never want to leave. Right.
Yep.
So, yeah.
That's great. I love the idea of building a, it's a mini business within the business. They're still working for Convoy, but you're building this mini business within. What's a favorite book that you can pass down to our listeners?
I don't think you can see it in the camera that we have on.
Pull it up.
I'll steal it, but we, we're based in Los Angeles. We grew up in the Kobe Bryant era, if you will. So this one just kind of came straight to the top of the head when you asked that question, and I think we both can just say that Mamba Mentality by Kobe Bryant is definitely something that everybody, whether you're in business or any stage of life can take a lot out of.
I have not. That's the first time somebody said that one to me. I've actually heard of it before. I've not read it, so I might have to grab that book and take a look at it.
It's funny because for us, I think for me, I personally, I visualize, and I don't know if you're a basketball fan, but the game where Kobe blew out his Achilles and he walked back to the free throw line, took the free throw shots, and then walked off the court, right? And all of that like buildup of pain and going through it, that's like I think perfect for a business owner, right?
Yeah.
And how we have to as a business owner and as entrepreneurs be in a mindset of yes, it sucks right now, but how do we come back better? How do we come back stronger? And how do
Yeah.
we, in the moment, still get the job done, right?
Yeah.
And that's kind of where we have, I think, differentiated ourselves from a lot of the competition, just because if anyone that works with us, they'll get emails at weird hours, like 2 a.m., 1 a.m., early in the morning. And then they'll also realize that we literally don't stop working, right? Dustin and I are constantly on calls, messaging people, trying to keep as many relationships and balls in the air as going. So we prioritize that. So we try to make sure that we carry through that whole Mamba mentality into our business and our day to day, so that at the end of the day, we know that when we're not really good at sleeping, but when we sleep, to know that we put everything out there on the court for this day, and then tomorrow's a new day and we restart.
Yeah.
Yeah.
Not very good at sleeping, but man, you sleep well when you do. That's good. All right, last question. What are your three pillars of wealth creation?
Obviously, we'll start with the obvious that we firmly believe in and practice and preach and are good at offering steps for clients to do this as well. But real estate's got to be at the top for both of us, or number one. You wanted three for, I'll let John do the second one.
I think no matter what you're doing, it's doing the work, right? And I think a big part of that is doing your due diligence, trying to learn as much as possible, coming into a conversation almost with, whether it be with a real estate professional or a financial advisor or whoever you're talking to, coming into the conversation knowing kind of already the gist of what's going on because you've already
Yeah.
done the research. Because I think a lot of times it's better to be surprised with new information that's pleasant rather than have a million new pieces of information hit you like a ton of bricks and put you to your butt to the ground, and then you're trying to scramble things together. So do the work prior to, learn as much as possible, gather as much as information as you can, and then be able to use that to make the right decisions, right? And that comes with those longer hours of studying and really just going through the practice rounds.
Yeah, I mean, we'll talk about the Mamba mentality with Kobe Bryant. He was a perfect example of putting in the reps, right? And that guy would show up to the gym hours before everybody else, and he'd even have a personal trainer, and they would say they're going to show up at 4, and he'd show up at 3,
Yeah.
right? And so, big perfect example right there.
Yep. Was that two?
Oh yeah, that's two. One
One
more.
more.
I'll do kind of a curveball, but maybe not really per se. But wealth doesn't have to be with a dollar sign in front of it. Doesn't have to be tied to money, and I think a lot of people do lose sight of that.
Yeah.
And wealth can be, in my opinion, whether it's family, wife, partner, kids, being in the nature, being out wherever you like to enjoy. Because at the end of the day, are you living to work or working to live? And that's what you got to always judge and balance your own self of what wealth truly means, to you.
Yeah.
That's actually a good pillar.
That's one of the reasons I love that question, is because I get some people that go really tangible. You guys have done a little bit of both, right? You said real estate, you said doing the work, but then you're talking about wealth being more than just the monetary value. And that's why I love the questions, because I get so many unique answers from it. And you're right, wealth is not just about the dollar signs, in my opinion, and in yours, obviously, too.
Yeah, no, it's something that I've personally lost sight of a lot I know John had, a lot of business owners have, a lot of real estate investors have. But if you're not happy and you're just making a bunch of money, then why are you doing it?
Yeah.
Right. So you gotta find that right balance, or you won't be able to wake up the next day and put 120% in to make that extra, dollar and accumulate dollar wealth if you're not happy on the other side of wealth.
Love it. Gentlemen, really appreciate you joining the show. And how can our listeners get in touch with you guys? Obviously, Convoy Home Loans. Where can they reach out?
Go to convoyhomeloans.com, and there's a little info tab, get info, put in your personal information to have us reach out. Or you can email info@convoyhomeloans.com, and we'll definitely get a hold of you there.
Cool. Again, Jonathan, Dustin, really appreciate you guys, and you have a fantastic rest of the day.
Thank you so much.
Thank you.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.